Hello, everyone. Welcome to today's session. Let's get underway here. Let me just open up one more application. There it goes, that little drawing tool. And let's go through market conditions here as well. I've got this chart here. Pull into, this is the sentiment chart on the 3-year time frame, S&P 500. And wanted to go over this perspective to just kind of help us. We'll go back through directional alerts and buy sell ratio and a couple of the others, but just see to help provide a little bit of context right here, context of the current market trend. We already know the larger context. We use directional alerts for that larger context. In fact, let's bounce back out there and start there just so we can keep things uniform. The overall uptrend, we know that we're at the upper end of this range and we're curling back up. As I've mentioned over the last few months, this upper range, this 20 to 22 range, this has never been higher than this. This is as high as it's been, at least in the last 20 years. So really even any of these spikes right here. So this spike is this spike right here. This, just as a reminder, this upper range is 1 year, and this lower one right here is 20 years. And so we're just getting just a little bit of a glimpse of the shorter term trend and with the context of the longer term trend. So we know that we're sitting right here, and we've rallied back up, and now we're at all-time highs on S&P 500. I mentioned on last week on a retracement pattern, this possible retracement coming here, this counter trend, and there's the really bullish scenario is that this is actually starting a wave 5. Okay, we talked about that trend advancements oftentimes in terms of Elliott wave analysis, trend and counter trend in 5 and 3 waves. So 1, 2, 3, 4, 5, 1, 2, 3 counter trend type process. It's not exactly that clean, but the general idea is really sound, that we get an uptrend and we have to retrace or counter trend a certain percentage of that. Oftentimes it's 50% or halfway, at least within some shorter term trends, and then we find some support. It creates a demand zone, and then we start to move back this other direction. And so that's the most bullish scenario right here. The hard part about that is how much can it advance already at the upper end of the range. And that's where we start maybe forcing the thought of, well, markets go up forever and stocks are always going to be moving higher, and AI is going to save everyone because it's going to be so efficient. And same story has happened over the last, through all mankind in terms of speculation and creating valuation in a marketplace environment, going all the way back to or for most of us going back to the .com bubble and in 2000. I think that was where a lot of us kind of got started. I started in 98, and so it was, we've seen we've seen this over and over again, that we get these big run-up speculation moves. In fact, this entire move, I even traded the 10 years before. So this has really been, and ultimately, as I mentioned, the design for the bias of owning stocks is going up. That is the bias. Okay, so don't get super sucked into really doomsday stuff that is like, the world's coming to an end and the economy is going to collapse and we're going to get this and that and this. That's people looking for viewers and for clicks, and it's getting harder and harder to get people's attention. And so a lot of the headlines have to be a little bit more aggressive, a little bit more outlandish to get attention. And the really fierce doomsday type stuff, it's always a possibility, but it's just not real probable. And so, but what is probable is human nature. Okay, that's pretty probable. That's pretty predictable. And human nature ultimately is driving all of this higher, and that is, we think that things are going higher, and ultimately it's going to have to prove itself. Ultimately, companies have to generate revenue in order to justify a higher stock price. They have to generate profit in order to justify a higher stock price. If the underlying companies don't do that, stocks are not going to go up. So it really is, ultimately, stock prices are based on the true valuation of an individual company. Is it increasing or not? And is that growth happening or not? At this point, this is where we start to run into when we say things are priced to perfection, and it's like, okay, we're pricing this into perfection. Now we're at a level to where we say, if this is you know, if the value of the stock market is 1, let's just say it's the value right here is at 1, what's the probability at this pace for it to go to 2? Okay, on an individual stock, and you know, maybe I just haven't seen it really, honestly, in AI. Yeah, it's cool, but in terms of massive profitability, there's only a handful of places we've really seen it, and that's in stocks. That's in infrastructure, the chips, the energy producers that are going to be providing energy to all these data centers. Those are doing well. It really is still, there's just still a lot of questions out there on how much higher we can go from here within this current trend. Not saying it can't go higher, but look what happens when we do get a little bit extreme is we ultimately pull back to that, to that sustainable trend, about that 45-degree angle of a trend line. And we're going to get there eventually as well in this market, but who knows when. So as of right now, that's our context. Our context is, where are we at right now? What does that mean for us to be able to progress going forward? Now, that being said, we still want to focus on the shorter term more than in addition to that longer term pattern. So our shorter term signals, obviously we're at the upper end of the range. Momentum is towards that upper end of that range. Breadth is really just the participation in the trend. Are we getting a large percentage of stocks in that uptrend? We've really dealt with that this last, really the entire rally of this entire year right here. This last part particularly, we did not get much participation. It was kind of in this range. I think we topped out about right here. So it's still, we're still seeing, and that's not abnormal to have less participation towards the upside of a trend. Buy-sell ratio also helps us tell that story to see, we are extended, but we're not as extended as we can be, and we just barely started. We just barely had this crossover here. Now, what is that going to look like? Is that going to look like this one? Is it going to look like this one? Is it going to look like this one? Is it going to look like these? Is it going to look, or is it just going to immediately reverse? We never quite know the exact form and depth and intensity of these overall trends, but we certainly know that when we have green above red, we're in an uptrend. When we have red above green, we're in a downtrend. It's not a great time to be buying stocks. It's a better time to be buying stocks. So these shorter term ebbs and flows and price patterns, and we also can add into that and say, well, I know that the market as a whole, S&P 500 is not the whole market, but it's pretty good. It's probably good enough or close enough to say this is the market trend. And we see that as price is going higher, this was when we have a buy-sell ratio of less than 1. This is where we have buy-sell ratio positive than above 1. So that's a very simple, fast glance to be able to look and see what is our current trend and how deep are we into that trend. We know that when we have a really wide readings, and we can look at this and say, how wide are we? We're wide enough that it doesn't get any higher than that, either bullish or bearish. We're not there yet on this trend, but we certainly could get, kind of that 3-part move that we often get with some spikes right here, and we get a pullback and then a spike and then another pullback, and then things ultimately reverse. So that being our shorter term bias right here, we're still bullish. We're approaching the upper end of that range. Sentiment also. So let's jump back to this sentiment chart. I had that 3-year time frame because I wanted to go back and look and see, about each time. We're not extreme, but we're in that range. We're in a range where we've seen reversals happen almost all of these. Now, these were relatively quick reversals, up and down, up and back, up and back, up and back. But these last few here and this long one that we had here really just hovered in this upper range. Now, I also like to use this as a 2-part indicator, and that is, are we above the 50%? That helps us say, yes, it's an additional confirmation that we're in this uptrend. Now we can look for the bias of buying pullbacks. Okay, instead of saying we're going to sell everything right here at the top, we're going to realize that we have some risk of a pullback, and we need to, whether that means lightening up on our overall holdings. The 2 ways to do that are through cash allocation, meaning we're going to increase our cash levels by doing one of two things or both things, and that is selling losers. So stocks that are lagging and they're not doing what we want, but they haven't been stopped out. One of the ways to raise cash is to sell those first. Sell the dogs, sell the ones that aren't working quite yet. Then if you get into a position where you need to raise even more cash or feel more comfortable raising more cash, then you sell your weaker winners. Okay, start at the bottom. And then on the upside of that, to sell your winners, you can sell a portion of those winners just to rebalance those holdings back in to alignment. Case in point, it was last week, but one of the trades here, USAP has been a decent winner that we've had this year. I think we bought it. It's up about 60%. We bought it right around here. As it's starting to get extreme and up into these levels, and it's starting to do that, okay, that now we can say, we need to remove some risk from this trade. And the way to remove the risk is to remove the number of shares that we have. So we've got to sell. And this is one of the ways to sell into the strength, is saying this is moving higher, it's really strong, and my allocation towards that has now gone from 2.5% or 2%. We've been doing almost all the new trades recently around 2% allocation. And if that goes from 2% to 4%, now my allocation is, and that in this case, if we bought it at 2% and it went to 4%, we would have doubled the money, right? We would have increased by 100%. Once we get to that point, we don't have to get to that point, but once we get to a point where we're thinking that this is now a bigger chunk of the pie. If we go to the portfolio and say, here is the slices of the pie, USAP was taking a lot bigger chunk. It was taking almost both of those right there. So it was becoming a larger piece of the pie. Once you get a larger piece of the pie and it's up here and it retraces, that stings a little bit more. Okay. So that's a double-edged sword, because it's a trade and it's a stock that's working well for you, but at the same time, and so you don't necessarily want to sell all of it, but at the same time, a retracement can add a lot more volatility. It can add a lot more pain as things are moving back and forth and to the downside on a larger holding. So selling into strength and rebalancing. So you can kind of see now just approximately those slices of the pie, they're all about the same size. We really don't have one that is really out of balance, and we'll see how these go from here, right? So selling into the strength, and that's one of the other ways to raise cash right here, is to say, I would go through this list and I'd say, okay, we've got a couple. GCT is about to get stopped out. It just hasn't been moving higher, but it's kind of retracing. We've got a stop level sitting right around here, and it's just now working back to the other side based on a buy signal here. They just, sometimes they work, sometimes they don't. But if they don't work, and they should, and they retrace, we just got to get out of those. And we've got to either stop out or get to a position where we say, this thing's just not working. I'm going to exit out of it before I get stopped out. Now, the flip side of that, we've had it happen before too, is the second you sell it, it finds support right at that support area and then starts to move higher. So it's, if there was an exact perfect way for every single scenario, then there would be a lot more billionaires in the world, because it's a difficult, this is the most difficult part of this process, is there's going to be stocks that do continue to move higher, and there's going to be some of those that just don't, for whatever reason. Okay? There's a million reasons why it's working, or a million reasons why it's not working. In my opinion, you never quite know exactly all of the reasons, because price includes all market participants. Everybody that is interested in this stock are making their decisions. They've either made their decisions or they're making their decisions. So price is really the best indicator to tell us what is happening. Well, this thing's going down. Now, what ends up happening, the problem that ends up starting to happen here, is we have a hard time as human beings. Our natural influence, our natural characteristic, I guess, is to not be wrong. We don't want to be wrong. And so sometimes in order to not be wrong, we have to lie to ourselves. Okay? And in lying to ourselves, we say, man, well, it's going, I think it's going to bounce from here. Well, what if it bounces from here and then it drops? And it's like, oh, well, all right. Well, now it's really got to bounce. There's support here. I'm not going to sell it because then I'm going to take my loss and then I'm really going to, and then once it's gone, it's gone. And we start to lie to ourselves that this thing is going to do better. And it ends up turning into a situation that it's like, well, dang, I bought it at 30 and now I own it at 11. What happened? What the hell happened here? And where was I? Why wasn't I paying attention? And then we realize I was paying attention, but I wasn't following my plan, or I was making bad decisions, or again, whatever the scenario is in terms of us not following our structure. This is really why we want to follow the structure, because we're going to win some, we're going to lose some. We have to make sure that those losses are small. Okay, and small within the overall trading plan. In this case, 15 to 20%, even up to 25% is allowable on a lot of these trades because we have small position sizes. Okay, and that's the approach that we're using. Is we have more positions, but we have smaller position sizes, and we're still exposed to market risk. We still have market risk, even though we're in stocks like gold stocks and steel stocks, and there's some oil here, and UEC, which is uranium, which is also starting to kind of ignite here a little bit as well. We're still subject to market conditions or market risk, meaning if the market goes down, oftentimes all stocks go down, whether or not it's gold, silver, uranium, or whether or not it's a kind of a counter trend type of idea. So that what that means then is we need to be aware of this as well. You can see I rarely go above 50% cash, and sometimes we'll get up into, if the market conditions are really good like they were towards the end of last year, we were up to about maybe almost 75, is like 65% allocated. And the market typically creates that. Now we're in an uptrend, which means more of these positions are working, which means we haven't been stopped out, which means we have more of them. Okay, so as the market rolls over and trades start to stop us out, we naturally end up getting stopped out of trades. That's happened quite a few times this year. This year's been a little bit more of a challenge towards the upper end of this range, because we're getting a lot of stocks that are speculative, moving higher, but at the same time, the second they don't live up to their earnings, which are already priced to perfection, stocks get clobbered and they just get beat up. And we've had a few of those with some bad earnings that have dropped. Point being here is it's still about risk management and allocation and deciding, man, this thing, I just can't afford to take any. If there's a chance that this market could drop by 20 or 30 or 40%, and that's a lot, let's say 20-25%, that's certainly probable at these levels. Then what does that mean? What do I need to do in order to mitigate the risk that is assigned to me, right? My age, my circumstances, all of those things are different for everyone, and that is really the nature of stock trading, is managing risk, because we can't tell the future. None of us can. None of us know exactly what's going to happen. None of us know exactly which stocks are going to work and why. And so we have to manage that uncertainty by not going all in, okay, and not doing something stupid or saying or my position sizes are too big. It's okay to have small positions, okay, because it's just going to reduce some of the volatility. So let's jump back here. So we're right at that range. That's really our context of the market conditions right now. Upper end of the range. Bond yield curve has still not really come into play yet. I do want to bring this up each week because this is still a concern. This still has to be rectified. This has to be fixed. Okay. And how does it need to look? It needs to look like this. Okay, so what we need, this is a healthy looking bond yield curve. Short-term yields are lower, they're way down here. Long-term yields are higher, okay, but look where they typically happen. And if I go back here as well, that's a healthy bond yield curve. Where they are unhealthy are typically at market tops. Here, that's 2000, here, 2007, and really most of this last move here we've gotten this massive inverted yield curve. So we've got, this is really one of those things that it is sitting there and people are talking about it, but it's like, yeah, well, whatever, stocks are going higher. So at some point, this is going to be an issue, but it's a very slow moving issue because sometimes it can be 18 months. And we're approaching 18 to 24 months now of having inverted yield curves. This has been upside down. And typically the 2 and the 10, the 2-year here and the 10-year, if the 2-year yield is higher than the 10-year, that's typically the definition of an inverted yield curve. Okay, this is higher than that. So we started that last year, started it even longer. Let's go back and say, yeah, really that top, it was really right in the middle of that retracement of last year, and even the bottom right here. So this has been the Fed right here, and it's interesting that we see equities moving. We've seen equities moving higher as the interest rates have been here. Eventually, it's because the market believes the Fed is going to lower interest rates at some point. Okay, well, typically they have to lower them because we're in recession or things are getting worse. It's a big giant circus, if you ask me, but it's the games that we have to play. These guys are the ones that rule the money supply, and ultimately that money supply is going in and out of equity. So that's my point of bringing this up is that's our context. Our context is economically, we don't have a real healthy situation for debt, okay? Debt being bonds, and that being the ability to borrow, okay, and the ability to borrow cheap money short term or borrow money long term. That's an issue. That's going to slow. I know that in terms of consumers, we're dealing with home equity lines of credits or car loans or credit card debt, or the cost of that is pretty expensive, and that's on purpose. It's purposely forcing us to not spend money and not move the price of goods and services higher. I don't know how well it's going to be working here. In fact, if you look at this is another potential concern, is if we look at commodities. Okay, commodities, we're seeing massive inflation. Okay, let's look at silver. This is the price of silver skyrocketing, gold also moving higher, and now we're seeing copper having this massive run up here. So these are things, and then also oil. Okay, oil has been moving higher. It's been pulling back a little bit, but it's in this overall uptrend and finding some support right here. That's the wrong direction. Okay, for oil, that's the right direction shorter term, but and we don't eat or silver, gold, and all of these things, but they in particularly copper, they're raw materials. They're raw materials that companies are buying for different areas of the economy or their products, and that just increases the overall cost that we have to pay as consumers for different products and services. Keep an eye on those, Eric. Keep an eye on market conditions. Let's just jump back in. Let's do just a quick discussion here on S&P 500. Now, really, we really don't have to really think too hard until we break back down underneath the 525 range. Okay, that's going to be an area where if we start to retrace, and if we find some support right here and it does move higher, that actually could give us, we could get a really big rally off of this bounce, and we'll see if that ends up being the case. Once we get, if we get up into the stratosphere, then we'll be able to really start to make some easier adjustments at that point. Right here, we're still kind of at that breakout. Things are moving the right direction, not having a lot of volatility. And if bonds start to pull back down again, then and interest rates or bonds go up and rates come back down, markets are going to like that as well. I'm going to end on that note. I appreciate everyone's time and effort today. I hope you find value in these presentations, and we will see you next time. Thanks a lot. Bye now.